There are two completely different markets being priced in right now, and only one of them will survive April the 21st. On one side, we have a peace scenario where oil drops $20 in days, inflation cools, and growth stocks rally hard. But on the other, a full escalation where an oil price of $100 becomes the floor and global recession risk spikes instantly. And while retail investors are waiting to see where this is going, smart money is already making its move. Because history shows that the biggest market gains are not made after peace is signed, but when uncertainty is at its absolute peak. So today, I'll be breaking down the historical data to reveal the exact sectors that will skyrocket if a deal is reached, and why your current defensive investment might face a brutal double-digit correction by next week. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. So, as of this recording, we are looking at an April 21st deadline in Islamabad. That's when the ceasefire is set to expire, although the situation is pretty fluid and this deadline could change. But for the market, this isn't just a diplomatic date. It's the moment we find out if a $100 oil price is a temporary spike or the new normal. Since the strikes in Iran began on February the 28th, Brent oil has climbed 40%. The IEA is calling this the largest supply disruption in history. And they aren't exaggerating. But the price isn't moving in a straight line. And that tells us something about investor sentiment. Look at March the 30th. The second the market caught wind of ceasefire rumors, oil dropped 15% in a single session. And when those talks stalled 3 days later, it jumped back up. Now, this volatility is purely driven by the Hormuz risk premium. Right now, 20% of the global supply is effectively blocked. And if a deal is signed on the 21st, that premium doesn't just soften, it evaporates. We are likely looking at a $20 drop in the short-term oil contracts within 48 hours. But on the other hand, if the deadline passes without a signature, an oil price of $100 is the floor. The reason this matters for our portfolio right now isn't about politics. It's about the valuation gap. Because the spread between these two outcomes is the widest disconnect we've seen in the macro environment since the pandemic in 2020. Most retail investors are waiting for the news to break before they move. But if you look at the historical data, the biggest repricing happens while the uncertainty is still high, not after the peace is signed. So we have to look at the history. Because the way the capital rotates during such uncertain times is remarkably consistent. Many retail investors assume that the market bottoms when the peace treaty is signed. But the historical data says the opposite. Markets usually bottom when the uncertainty of a war becomes a known outcome. Take the 1991 Gulf War, for example. The S&P fell about 11% in the month leading up to the conflict. But the day the actual bombing started, when the uncertainty peaked, the index didn't crater. It rallied 3.7% in a single session. And by the time the ceasefire was signed in February, the market was already up 18% from the lows. So if you waited for the official ceasefire to buy, you missed most of the immediate upside. This is known as the uncertainty paradox. The market can price in a war, but it can't price in a maybe. LPL Research analyzed different geopolitical shocks, from the Cuban Missile Crisis to the war in Iraq. They found that, on average, the S&P 500 recovered its entire war-related loss within 47 trading days. That is less than 2 months. But we have to be a bit careful here, because there are two different types of geopolitical shocks. There is the 1991 information shock, which is what we are likely seeing right now, and then there is the 1973 supply shock. Back then, the oil embargo wasn't just a temporary disruption. It was a structural shift in how the world's energy was priced. And that led to a decade of stagflation. So if the peace talks fail and we see even more permanent damage to Iranian or Saudi infrastructure as we already have, we are in a 1973 scenario. And that would be a fundamentally different issue. However, the current setup looks more like 91. We have a massive risk premium baked into oil and still at least some fear discount baked into tech and financials. But the moment that uncertainty collapses, whether it's through a deal or a military outcome, this would change instantly. So the question isn't which markets will rally, it's which sectors will benefit the most. Because when the rotation starts, the money doesn't go back to where it was. It goes into the sectors that were previously punished. We are talking about a multi-billion-dollar exit from defensive hedges into growth. To understand where the money goes, we have to look at which sectors have been the most distorted by the war premium. So let's start with the biggest war winners, defense and energy. Because there is a common trap here. Many retail investors buy defensive stocks after the conflict escalates, thinking that these will benefit most. But historical data shows that defensive names like Lockheed Martin here often peak at the start of a conflict, not during it. The peak for Lockheed Martin, for example, was just 4 days after the start of the war. Since then, the stock has fallen by over 10% again. And if a peace deal is signed on April the 21st, defense isn't just going to flatten out. It's probably facing a 10 to 15% downside correction as the war premium is priced out. And the same goes for energy. Especially if you're holding oil companies and drillers, you are effectively long the blockade. But when the blockade ends, your margin of safety disappears. But here is where the peace dividend gets interesting. The biggest winners in a ceasefire aren't just everything else. It's the sector with the highest sensitivity to energy costs and interest rates. Tech has been hit with a double-edged sword. Rising energy costs that make everything more expensive for consumers, while the resulting inflation keeps bond yields and interest rates high. But if oil drops back to $75, the inflation expectation would be lowered. That gives the Fed and the ECB room to breathe. And those growth multiples that looked expensive at a 5% yield start to look attractive again. Now, that's the most obvious play. The more subtle play is the guts of the global trade, specifically airlines and logistics. But before we go there, if you value this kind of data-driven research over the usual retail hype and think it helps your own investment, please hit the like and the subscribe button to not miss the next video. As a small channel, every single like and subscribe goes a long way to show the YouTube algorithm that this is a video worth watching. So thank you very much. And now back to the airlines. They often move counter-cyclical to the oil price, the blue line here. Because during the blockade, jet fuel prices in Europe and Asia especially have spiked. Carriers have been rerouting their planes around the conflict zone, increasing flight time and maintenance cost. A peace deal wouldn't just lower the fuel bill, it would help the entire operational efficiency. We are looking at a massive margin expansion that isn't currently reflected in the Q2 guidance. And then there is the financial sector. Since February, the M&A pipeline has effectively frozen. Strategic buyers don't sign huge checks when they don't know if the Strait of Hormuz will be open next month. Private equity is sitting on record levels of dry powder because the debt markets for leveraged buyouts have tightened. Just look at the corporate credit spreads. This is the extra yield investors demand to hold corporate debt over safe treasuries. And they have widened significantly since the war started. That makes it more expensive for companies to borrow, which hurts the lending pipeline. But at the moment a peace deal is signed, those spreads will come down again, as we already can see here. So you basically get a simultaneous relief of bottled up M&A activity and an increase of credit availability for companies. And for the big investment banks like Goldman Sachs or JP Morgan, that's a massive surge in fee-based income. So the takeaway here is simple. A peace deal isn't a rising tide that lifts all boats. It's a transfer of value from the hedges back to the growth engines. And if you're still heavy on defense and energy on April the 20th, you are not hedged. You are exposed to a major repricing event. Now, the Strait of Hormuz is only 21 miles wide, but it's one of the biggest bottlenecks of the global economy. And as we all know, when the blockade began, it was closed. And for shipping companies, this wasn't just a risk, it was an insurance problem. By April the 10th, war risk premium spiked to 3% of a vessel's hull value. For a $100 million tanker, that's a $3 million bill just to enter the Gulf. A deal in Islamabad could end these extra charges overnight. But the real alpha isn't in the shipping stocks. It's in the manufacturing hubs they serve. China, India, South Korea and Japan have been paying a blockade tax on every raw material they import. India alone has $178 billion in combined annual trade flowing through the strait. So when ships move freely again, the relief rally in Asia export indices will likely outpace the S&P 500. They are the most compressed assets in this conflict. And while most investors, including me, spend most of their time looking for the right ticker symbols, right now the where matters even more than the what. In Europe, we can look for example at Germany and Italy. High energy costs there don't just hurt their consumers. They destroy their industrial competitiveness. We are seeing a technical recession and stagflation that looks a lot like the mid-70s. In Asia, India and Japan are also effectively giant energy importers. And every $10 move in the price of oil adds billions, especially to India's current account deficit. But here is the thing. The Indian Nifty 50 and the Japanese Nikkei have been pricing in a worst-case scenario during March. If oil reverts to $75, the relief in the markets will be massive. But some of this has already been priced in since the peace talks started, so the potential surprise to the downside if the talks fail would be real here. When we look at the US, the S&P 500 is tech-heavy and relatively insulated from Middle Eastern energy compared to Berlin or New Delhi. That's where the US has outperformed during the conflict. But in a peace scenario, that leadership flips, and we can see this with the Nikkei in blue here already. I think we're looking at a rare moment where the risk on trade is actually safer in international markets because they have the most to gain from a return to normalcy. So if you're only looking at US large caps, you are missing half of the trade. But what about the other side? What if the April 21st deadline passes without a peace deal? Charles Schwab models different scenarios for each outcome. And if the peace treaty fails, the markets move from a temporary blockade to a permanent conflict, which would have a severe impact. In this scenario, a $100 oil price is the starting line. According to their model, this would mean a global recession and bear market. To hedge for this, you can look for defensive assets. Consumer defense stocks like Ahold Delhaize or Procter & Gamble are the textbook examples here. These are boring consumer defense giants with a very low beta. But these are volatility shields, not growth plays. The other structural hedge is European renewables. This conflict has turned wind and solar into matters of national security. And for companies like Vestas or Nordex, high oil prices actually improve their relative unit economics. And even if the talks fail and the broader market bleeds, the importance of domestic energy production is accelerating, as I have talked about recently. It's one of the few sectors where the investment thesis is actually strengthened by a continuation of the war. So the market is currently pricing in a coin flip. Oil isn't yet reflecting a $75 peace scenario, but it's also not fully accounting for the $150 escalation models either. This creates an asymmetric risk, because the 40% spike in oil price has already done a lot of the heavy lifting for the bear case. If talks fail, a further jump to $125 to $150 could be a significant shock. But if a deal is signed, the war premium doesn't just fade. It would collapse within a few days as 20% of the global oil supply is effectively unlocked immediately. In 1991 and 2003, the market didn't wait for a peace treaty. It bottomed at the moment of peak tension. And right now, it looks like we are already on the way back up. And the statistics point toward a relief rally in the sectors that were unfairly punished. But if you're waiting for the headline on April the 21st, you will already be too late. But as always, that's just my opinion. Now, I would like to hear from you. Do you think that we will have a peace deal in sign this time next week? Or do you think that the war will escalate further? Let me know down in the comments. And if you would like to position yourself for a fall in oil price and want to know which oil company offers the best investment opportunity right now, check out this video next. And of course, This is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.